Good afternoon, everyone, and welcome to our breakout session. This one is called Responsible Finance. Perhaps even more common name would be Sustainable Finance. I kind of like responsible, so we kept it that way. My name is Per Olsson. So I'm a professor here at ESMT, Accounting and Finance. I came here in 2015. Before that, I was in the United States for 20 years, mainly at Duke University. But as you can hear on my accent, which isn't really that American, I'm originally from Sweden. So we're gonna have a short session, 40 minutes. So it'll be a bit of scraping on the surface. But you will have my contact details and so on. If you want to go deeper into something later on, more technical perhaps or something like that, you're always welcome to contact me. So a quick introduction. And these pictures, you've all seen this or similar pictures, I'm sure. So what's behind it all? Well, one thing that's behind it is global warming here. And the people who put this graph together, as you can see here, it goes from 1850 up until now. And the reason they're starting in 1850 is really that's their start. That's when they think the Industrial Revolution really started. And they've normalized it. So 0 here would be the average temperature between 1961 and 1990. So back when in 1850, it was a little bit lower. But as you can see, it has really spiked in the last few decades. And you know that, of course. We can also take a slightly longer perspective on this. So now we're going from 800,000 years BC up until now. And people have tried to estimate and measure the concentration of CO2. And as you can see, for the vast majority of our history here, it's been relatively stable, except for now. When it has really spiked. And when you take this sort of long-term perspective, I think you really see that we are in something that is, to say the least, unusual. Another thing that we often talk about, and that is perhaps, well, not perhaps, it is bad for the planet, but we're also going to see that it's bad for economic things here, has to do with biodiversity. And I'm not going to read the entire graph here, but if you summarize, at least according to the article where this is taken from, then somewhere around 25% of all species are under direct threat, and that would translate into something like 1 million. So that's again a very large figure here. By the way, if you want to make a question, make a comment, feel free to do so. If you are in the room, then you have to use the microphone. The reason is not that I won't hear you otherwise. The reason is that the people who are online won't hear you otherwise. So the prior couple of slides had to do with the environmental challenges, what we often call the E and the ESG, economic, social, and government issues. But as you know, there are other issues, of course. So on the S part, the social issues, we have a bunch of things happening. And I think these pictures, they speak for themselves, and we need not actually go further on them. What I want to concentrate on today, because it's called finance, is then how does this translate into economic risks and potential issues that has to do with the pricing of risk, lower cash flows, things like that, things that would affect valuations in different ways. And when people talk about these things, they very often make the following distinction of these economic risks, namely physical risks, transition risks, and liability risks. So the physical risks, those are there already right now. We saw the couple of slides before. So these are things when the temperature goes up, and we may have floods and so on. So these things are costly, and they're costly right now. So just to give you some figures here, this is from Swiss Re. They have estimated here what would happen to gross domestic product under different scenarios for temperature increases. So as you can see here, when we have the Paris Agreement and the targets there, so well below 2% increase in temperature, we're seeing that that's going to be costly, but perhaps not a complete disaster. But as soon as we're getting above that Paris target of 2 degrees, then we're starting to see much larger figures here. So these are decreases in GDP. And these figures are large, very large. They will have real consequences for people. And as you probably know, fewer and fewer people believe that we can actually achieve the Paris Agreement target. So as a consequence, we're going to be probably somewhere in the rightmost 3 columns here. And if we're really unlucky, so we go to what they call the severe case, so a little more than 3 degrees increase here. You can see that depending on the area in the world, we have anything from 9.5% decrease to 37.4% decrease in GDP. What makes this a bit worse also is that it's not evenly distributed, as you can see here. Those of us who live in so-called very developed areas of the world, so North America, Europe, so we have the lowest effects on GDP of this increase. The areas that have the highest, that would be the ASEAN part of Asia, so Southeast Asia here, and Middle East and Africa, and also Africa, the rest of Africa here. So it's this unfortunate thing that the people who can afford it least will have the hardest hit from these things. The second category here has to do with transition risks. And what this is then when we move from one regime to another, then that's going to be costly in itself. Change is always costly. And in this field, some people talk about the inevitable policy response. So here's from the PRI here. The question for investors now is not if governments will act, but when they will do so, what policies they will use, and where the impact will be felt. The IPR project forecasts a response by 2025 that will be forceful, abrupt, and disorderly because of the delay. And that's where what we often have if we don't do things early on with an orderly change, then we are going to be forced into a more abrupt change. And abruptness is always going to be costly. And this is costly for individual people. We can see it right now. What's going to happen to our energy prices? It's partially for other reasons, but still, right? It's when you're forced into something immediate, and that will be difficult for people, for companies. There are lots of companies in this country that are really afraid of losing full gas supplies over the winter. So there, of course, have been responses to these things, and some of them have been more timely. So here's just an example, the PRI, the United Nations Principles of Responsible Investing. So here they say a lot of things here. I'm not going to read every bullet point, but let's do the first one here. We will incorporate ESG, so environmental, social, and governance issues, into investment analysis and decision-making processes. So now we're getting a bit closer to today's topic, namely investing. And how do we get these things into finance, more generally speaking? This PRI started back in 2006. Back then, it was a relatively limited number of organizations that signed on to it. But some of these organizations and corporations were extremely large. So it was not trivial even at the outset. And as you can see here, there's been a tremendous growth over time here. So last year in 2021, you can see that in total, we had around 120 trillion US dollars in assets under management from organizations and companies that had signed on to the PRI principles. And this is a big number. I mean, it's a number that I can't even get into my head. It's like, you know, what's he called? Donald Duck's uncle, Uncle Scrooge, who swims in money. It's that kind of sums we're talking about here. And socially responsible investing, that's a very wide term here. It's not well defined. And there are some definitions. And, you know, several of you have had exposure to academics. So you know that we'll have to fight about what is the correct definition. And each of us believe that we have the correct one. No one does, of course. But the title is descriptive enough for us to understand what might be going on here. And as you can see here, when they invest, when investors, professional investors, invest in what they call socially responsible investments here, there are a number of reasons here. Some of them have to do directly with climate change and so on. So you see here, address climate change and other environmental issues. Are there social motivations here contribute to the local community development? But at least when I saw this the first time, somewhat surprising thing is perhaps that many of them have to do with classical finance motives, earning money, taking down risk, basically. So you see here, we have the financial opportunity, risk management. And these are rather large categories here, stable long-term return here. When you speak to professional asset managers who are involved in this, and I come from Sweden, so I speak to a lot of them up there. And Sweden is, in this area, it's rather big. Often what they say is that, yeah, of course we do this for social reasons, but a lot has to do with risk management. A lot has to do with the reason that was here, a stable long-term return. So the question of stability. And these things, when you speak to people in that world, it changes relatively rapidly. So when I spoke to these people, I would say 7, 8, 10 years ago, it was much less about this. So then they were saying more like, okay, this thing is sort of a niche investment area. And you simply don't have that anymore. Almost all of them are talking about this more or less, and more or less willing. But since they are managing other people's money, oftentimes, so pension managers and so on, they have clients, and these clients have demands, and part of their job is to satisfy those demands. So here at ESMT, we had Andrew Ang here. I don't know if anyone was here to see it about 2 years ago. So he's the head of factor investing for BlackRock. And he himself is in charge of between $600 and $700 billion. And he was very candid about this, that it's hard for them to measure actual abnormal returns to this type of investment, but there is so much investor demand for it. So they cater to that demand and they measure it a lot. And to summarize very briefly, what he said was that it helped stabilize. So they had other trading strategies, other trading signals. Those of you who are into that type of finance, momentum investing and so on. But by interacting it with sustainability, so putting on a sustainability filter, those returns became more stable. And that is, of course, something that's valuable. I'm an academic. I do research, and I'm going to apologize on behalf of all researchers in this field, because this is not a pretty picture. We do not know that much about it. Theoretically, and I think most people agree with this, this should have to do with the cost of capital. If all this language about stability is true, and it seems to be, then more stable cash flows, more stable returns and so on, should lead to a lower cost of capital for companies. So, you know, a better ESG should lead to a lowering of the cost of capital. This is incredibly hard to measure, though. So I don't know how many of you have worked with these so-called ESG scores. They exist for many companies and more every day. And there are, yeah, well, God knows how many ESG scores there are in general, but there are at least 10 very big companies that deal with these ESG scores. So one problem is that they do not agree about this. There is very low correlation between the ESG scores. So the same company can show up in, let's say, Morgan Stanley's ESG score as a top company among the 10 best companies in the world. And according to, let's say, Sustainalytics, which is a big company, may show up as one of the 10% worst performing firms. This is something that if you're going to do something practical about this, it's frustrating. And there is, of course, a lot of work being done also on trying to come to some consensus about how we should think about this, how we should measure it. So there is standard setting going on with this, but it's just starting. And like I said, people don't agree. As a consequence, if you look at the actual empirical research, so people who have investigated what happens if you follow one ESG score versus another, if you define sustainability that way or that way, you get different results. So this is just numbers from a study. It's one of those meta studies where they went through a bunch of different studies, 155 to be precise here. And then the financial return, is it positive or is it not? And as you can see here, a neutral, that means basically zero return to this, a little more than a third of the studies. Mixed, also a little more than a third of all studies, so showing some positive, some negative. And then we have positive and negative, dividing the rest here basically. So when you see a picture like this and you show it to a policymaker, they just sigh. This is not helpful. For us who work at the university, it is helpful because it's a giant research field, and it's an interesting research field. So let's move on to more direct investing strategies here. So if you look at this right now, these are numbers from last year. Roughly 36% of total assets under management in the world. So financial assets, they are defined by these managers as sustainable investments. And as you can see here, even though there are only from 2016 and up until 2020 here, it is increasing and it's noticeable from 28% to 36% at the end of 2020 here. And these sustainable investing strategies, they have many names, but broadly they fall into three categories here. Exclusion strategies. So that means basically that no, we don't like that type of company. We will not invest in it, period. We exclude it. We have the opposite, inclusion. We really like this company. So it might be best in class or something like that. And that's why we invest in it. And then a category that is used to be very small, but is increasing rapidly, has to do with influencing. So that's basically when you say that, okay, this is not a very good company, but I think it's changeable. So we're going to take a stance here. We're going to take an investment, and we're going to try to influence the company to become better on this dimension. And you see that both in the private equity markets, and you see it in the public equity markets. So, you know, the very basic business model for a private equity company is find something that is handled and managed suboptimally, buy it relatively on the cheap, change it, and then manage it and change it over 5-6 years, and then you sell it at a higher price. So private equity used to be very small in sustainable investing, but last 2 years, if we look at the numbers, it's been an explosion really. And it's natural, I think, for the very reason I mentioned here. On the public side, it used to be the case that public investments, so we're talking about publicly listed companies on the stock exchanges, that investors there didn't think they could influence very much. There's been a lot of interesting research on this. So people have looked at this both from psychology, from sociology, from finance, and so on. And they find that it's relatively easy nowadays to build coalitions. So you don't need a major stake in order to influence a company. You need a large enough stake so they will at least listen to you. But then you can build coalitions within the company and start affecting change. But let's start with the perhaps still most common thing here, namely exclusion strategies. So this one is from Allianz Global Investors. So they have exclusions against what they call controversial weapons. So that would be things like mass destruction, forbidden weapons like cluster bombs and so on, nuclear weapons and so on. They have exclusion policy against tobacco and coal extraction. And what they say down here when they talk about a little more in detail is that the rule that they apply is that a certain percentage of revenue coming from one of these areas, it can only be a relatively small percentage. If it's higher than that, then that is the general exclusion criterion. And if we look at this more generally, this is from Europe. Stats are from 2018 here. You can see that indeed the most common one is about controversial weapons. And that's what most companies will exclude. Tobacco is indeed number 2. All weapons even, number 3 here. And it goes on, gambling, pornography, and so on here. And if you look at especially the upper categories here in the picture, some of these have been around for a long time. So some investment funds early on, I'm talking about the 1910s, 1920s and so on, came from, had strong religious beliefs associated with them. And for that reason, there were certain things that were just a no-no to invest in for them. You can figure out which ones here. So it's something that's been around. They just didn't call it an exclusion strategy back then. And if we look at the general different strategies to sustainable investing, you see here that on this graph, we have the dark blue numbers from 2020, the turquoise from 2018, and the green from 2016. So if we look at 2016 and 2018, you can see that indeed this negative or exclusionary screening, that was a dominant one here. However, what's been happening, and that's really exploding as we speak, and actually already in 2020 here, has to do with ESG integration. So that's now overtaken this exclusionary thing. And again, when you speak to asset managers, more and more of them are saying, no, that exclusion things, even from a moral perspective, they think that this is not necessarily a good thing, because there's always going to be other investors who may have less scruples, who will provide financing. So it's better to actually try to do something to affect change and so on. But this ESG integration, what that is, well, here's a quote from Mr. Voss here, so the head of global equity research at ING. He said a couple of years ago that the industry will likely move toward an integrated approach over the next decade. And this transition will require the mainstream analysts and portfolio managers to expand their skill set and adjust the way they analyze potential investments. And the way, what they mean by this integration is an integration between the financial analysis behind an investment and a sustainability analysis behind the investment. And also trying to monetize, put numbers, put dollar or euro numbers on the investment that they're contemplating. So this is a graph from Deutsche Börse, so the German Stock Exchange, their website about communicating sustainability. When they talk about integration here, yeah, we analyze the financials, we analyze environmental, social, and governance aspects, and together this will be an evaluation of opportunities and risks, and hopefully, and this will lead to an informed assessment of the ability of a company to create and to sustain value. And these things are easier said than done. So when we have courses now in sustainable finance, we try to find some analyst who is working like this, and it's not that easy. There are not that many, because most of us were trained in a particular way, typically a financial way, if you're a financial analyst, and it's harder to do this thing here. So last time, sorry for bringing up a lot of Swedish examples, but you know, you can hear from the accent that that's what you're going to get. So we had an analyst from SE-banken, which is the biggest private bank in Sweden. And they actually have a rule for all their equity analysts, and they have to do it this way. They have to do the sustainability analysis. They have to put numbers on it to try to figure out what's going to be the future consequences of environmental things, social things, and so on. For some of the things where we have prices and so on, like CO2, for example, it might be a little bit easier, although, you know, a few years ago, the price of CO2 in the EU was something like €6 per ton. I forget what it is now, 80, 90 or something. And it's very, very hard to forecast these things, of course. But at least conceptually, they know how to do it. So I'm going to leave some time at the end for some questions. So I thought I'd finish my talking with a little mini case here. So this is about VALE. Does anyone know VALE? Yeah. So it's a very large mining company in Brazil, or Brazilian company. This company has a lot of institutional investors in it, including pension funds and so on. And it's big. So you can see, I'm going to talk about something that happened in 2019. And in 2018, the annual revenue was a bit more than 36 billion US dollars here. They had one of these tailings dams. And these tailings dams, they store toxic byproducts from mining operations. It's a big thing for these mining companies. And this particular one was near Brumadinho in Brazil. It was built in the 70s. VALE bought it in 2001. And it had a classification by the Brazilian Mining Authority as having a low risk but high potential damage. So, you know, just like we usually say about nuclear power plants and so on. It had the correct licenses from the authorities in Brazil. It was turned off in 2014, but still existed, of course. It was inspected bi-weekly. And this is a picture from 25th of January in 2019, when something really bad happened here. So the dam basically burst. And 2 million cubic meters of mine waste came out. 200 people died that we know of, but many more are missing. In addition, metals may be absorbed by the soil around the dam and the rivers. So the ecosystems here could be affected majorly. And this was the way it sounded in the news reports, you know, on January 25, January 26 of 2019 here. Earlier, and also during this thing, the CEO of VALE was saying that, well, the material will likely not move that much. I said that this company had many institutional investors. It did. So let's say, play a little game here and say then that, okay, you are a portfolio manager. You're working for a European pension fund. You had a VALE in your portfolio. And this was not an uncontroversial company before. So the pension funds that did have a VALE in their portfolios, they have thought about the risk of these things. There's lots of writings about it, protocols and so on. But they still thought this was a defensible investment. And would you change here? Would you perhaps try to get out of this company after this disaster? In other words, that's question number 2, what strategy for active ownership would you employ? Anyone has any immediate thoughts on something like this? I know what I would have thought instinctively, but then I've hopefully sat down and thought a bit deeper about it.
Okay, then if nobody has the courage, then I go. Yeah. I would not have invested in VALE in the first place. If I would have been invested, I would ask from the management a report on how this broken dam could happen, despite bi-weekly inspections. What was the reason for it? And then I would like to see a report on all other risks in the company and how they deal with it. And if that is not convincing, I would drop the stock. In the minute.
Yeah. So you're sort of shooting for a bit of influencing here, actually, right? Like, you better have your house in order. If not, convince me that you will have it in order for me to remain on this. So we can see what one institutional investor did here. This is the largest Swedish pension fund. So they reacted instinctively, just like many of us are thinking now. We have no confidence in VALE. We will review our recommendations, and I find it extremely hard to see that we would not recommend the AP funds to exclude this company. And these AP funds, they handle something like between 60 and 80% of all pension money in Sweden, so they're large, even though Sweden is a moderately small country. But then they sat down and they thought further about it. So this is a press release from beginning of February 6. We suggest that we and other investors instead establish a global, independent and public classification system that will monitor the security risks for the mining company's tailings dam. So now we're seeing a bit more of this influencing thing rather than the gut reaction of exclusion. But then there was some new information at the end of the day before, but American time, Wall Street Journal put out this. An inspection report from a German consultancy here showed that from August 2018, showed that the dam had issues with draining and control systems. And it was determined that it barely passed the minimum requirements. Reuters, 5 days later, they wrote the following, that VALE knew last year that the dam had a heightened risk of rupturing according to internal documents. And these documents were dated in October 2018, showing that VALE classified the dam themselves as 2 times more likely to fail than the maximum level acceptable under the company's own safety policy. So now you're getting these indications, and that's perhaps you would draw the conclusion here that no, this is not trustworthy or believable here. And indeed, that's how this pension fund also reacted here. So the Ethical Council, and that's the Ethical Council for all the pension funds in Sweden, they concluded that the company can be connected to breaches of a number of international conventions, including Universal Declaration of Human Rights, ILO conventions, UN conventions, and so on. So then they withdrew their investments from this company. And there's a sort of after thing here. This in March 27, 2019, the International Council on Mining and Metals, the United Nations Environment Programme, and the Principles for Responsible Investment, they all announced that they will co-convene an independent review that will establish an international standard on these tailings storage facilities to try to make this better for the future for all companies. The governing board for this entity here is made up by the Church of England and the Swedish pension fund, combined pension funds. And if you're interested in this kind of stuff, it's actually more fun than it may sound, but it's fun. I shouldn't say that. It's interesting. There is a really good podcast called Talking Responsibly. So if you just Google podcast Talking Responsibly, it will come up. And the episode 13 is exactly about this case that we have been talking about here. So this is what I had here to say. Obviously, I mean, we see some former students in here and current also. So you know that when we do this in class, there are many more numbers that we go along with here. But their numbers are trying to fill the concepts that we're talking about here, that we've been talking about here. But it's a big thing for ESMT to try to move in a very practical sense into this area. And the practicality is also what's been lacking, I think, in research, which is also from an academic research perspective, why this is so interesting. So that's it. Here's my email address, but you can just find it on ESMT's website. There are only 2 Swedish professors, so if you can't go that wrong, you can write to us both. Any questions, comments, or anything?
We have a question from one of the 30 other persons online, from Sabrina Balkenhall. And that is, do you see this ESG investing transformation everywhere in Europe, globally in a similar way, or how do you think Sweden, is Sweden an advanced country and will move ahead even further in the next 10 years?
I think we all will move on further in the next 10 years. My impression is that, yes, it's big in the Nordic countries. It's big in France. In other European countries, it's not small, but it's lower right now, but it's increasing. In the research world, lots of research is being done on American data because they have so much more. And there we see very, very low effects, actually. So, for example, there is a very, very good study that was made on green bonds. So they compared so-called green bonds, where the purpose of raising the money is a green purpose, compared to almost exactly the same type of bonds, but without that green aspect to them. And they had predicted that there would be some investor preference for these green bonds, so-called greenium. And they found that, no, there is absolutely no difference between the two. So what they found there was that in the United States, there is no greenium whatsoever. Now, that when people discuss this kind of studies, because that goes to the question here, there are two things. We have perhaps correct, perhaps not, a feeling that in some countries, in some parts of the world, this has gone a bit further, and the United States may lag a little bit behind. Within the United States also, you may have differences. So East Coast, West Coast, maybe you can find something in between, perhaps less, and so on. But now we're getting all these ugly biases into my head here, and I shouldn't really have said what I just said, but you understand what I mean here. I think is also what's hard here to measure is that there's been so much development over the last couple of years. And by definition, we don't have enough data to make investigations. If we just look at 2020, 2021, we need more and longer data series to do that. There are more and more products coming out on the market. So there are sustainability linked bonds, for example, where if a company adheres to certain sustainability targets, gets certain sustainability rankings, it's written into the contract that the interest rate will become lower. So there are a couple of large French banks, for example, that are pretty heavy in this area, just as an indication. So I think we're going to start seeing effects in many places, but probably first in the Nordics and in France, I would think.
What about the search of indicators of irresponsible corporate behavior beyond ratings and audited reports? It reminds me of the Deepwater Horizon catastrophe.
Yeah. So I think non-governmental organizations are really important here to find these things. I think journalism is important. Even our little bin example with VALE, it was Reuters that dug up these firm internal documents showing that they had been behaving badly. So I think that's important. It's really a tough one though, right? Because with the new standards coming, there's this demand for auditing the disclosures. And the big accounting firms, they have traditionally been hesitant, and I understand why, of saying something absolute like, this is a clean company. And they have traditionally been willing to say, to the best of our ability, we think that they have processes in place to discover something that would be bad. But going further than that is hard. So I'll take an example like H&M. They had a big scandal with child labor a few years ago. And I happen to know the CEO rather well. And she used to be the sustainability officer of H&M. And I know that the heart is in the right place here. And they couldn't see that part of their supply chain. So I think even with the best of intentions, I think things can go bad. And I think we're working on another research project where it's about training workers in East Asia and in South Asia and in Southeast Asia into workers' rights. So it's a company that trains the workers, a lot of migrant workers and so on, by giving them a course. And then we're actually measuring on little tablets how much of that has come into that they've internalized, what are my rights and what could I demand, what can I not demand, and so on. And then we're trying to see how that corresponds actually to profitability measures, above all to the variability. And by extension later on to the companies, if these are independent supply chain companies, to the companies that hire these supply chain companies. So I think there's a lot of stuff to be done here. I think there's a demand for these things. I think simple technologies can help, but it's never going to be perfect, of course.
On one of your slides, you had the category of impact investing. How would you qualify impact investing? And there's a lot of talk about impact investing lately as a new trend. I mean, the assets under management were quite low. Do you believe it's interesting for asset managers, or can it be a good approach in order to increase sustainable finance?
Yes, is my short answer here. So there's not a completely agreed upon definition of impact investing. So I think the most common one is that you require a financial return, but also you should have some social impact, for example. Where this field is going, I think, is to try to monetize that impact. Again, that's something that we're doing research on. So try to figure out what the monetary value of what we call externalities, so the impact on society around, for example, would be. And it's doable with a lot of uncertainty. But you know, everything we do in accounting, even when we measure old-fashioned stuff in accounting, there's a lot of uncertainty around those numbers too. But I think that's where this field is going. And I think it's very good to do it like that. We have to finish here, but let me just say, so if you look at the low-hanging fruit in that sense, so CO2, which is relatively easy to measure. I mean, the coalition agreement in Germany, with the three parties in the German government, they've written into it that that should go into the accounting system in Germany. I mean, we'll have to see if they succeed, but there is political will behind this, and I think that's a good thing. Okay, one last.
Thanks a lot. Jürgen Borchardt from German NGO Kindernothilfe. And over the last 2 years, we have developed a sustainable investment fund focusing on child rights, child labor, child participation. When we designed all of this, we had a huge hope in the current process of social taxonomy in the EU, that because data are lacking, particularly in this field, that we would get a boost when it comes to reporting standards. Now I get the feeling there's not much going on really, and the standards are kept very low.
On the social side, so I speak a lot to politicians, and because many of them are really interested, but all of them have this approach, and I understand it, that, okay, let's do something that's doable first. And that's something, and then something like CO2 is measurable, doable in that sense. What you talk about is arguably more important. Well, actually, both of these things.
I think right now it's a bit of
fantastically important, but it's very, very hard.
Competition between climate and
but it's
social
of course very, very hard to put numbers on, right? So I think sooner or later something will come, but I think they're moving with doable item number 1, doable item number 2 first, which I can understand. Okay, thank you everyone for coming.